Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis welcoming you to my podcast Money Talk for Friday the 8th of March. Today is International Women's Day. Thank you for joining me for today's update of the business and finance news from across Asia. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's headlines, the European Central Bank kept interest rates on hold Thursday as expected, but lowered its annual growth forecast for the fourth quarter in a row and cut its inflation forecast. The ECB now sees economic growth of 0.6% in 2024 from a prior forecast of 0.8%. Its inflation forecast for the year was brought down to 2.3% from 2.7%. China's foreign trade grew faster than expected in the first 2 months of this year, driven partly by electronics and increased exports to emerging markets and Russia. Data showed that Chinese exports jumped 7.1% year-on-year in the January to February period to $528 billion, far exceeding forecasts for a 1.9% gain amid resilient foreign demand. The US is pushing Japan and the Netherlands to tighten restrictions on exports of chip-making equipment to China, following a series of advances by blacklisted Chinese tech companies Huawei and SMIC. The Biden administration wants Tokyo and The Hague to go further to close gaps in the existing regime. China's Foreign Minister Wang Yi said at an annual press briefing in Beijing on Thursday that the US has been devising various tactics to suppress China and keeps lengthening its unilateral sanctions list, reaching bewildering levels of unfathomable absurdity. Shares in Taiwan, Australia and India have closed at all-time highs. The Taiwan weighted index jumped 1% to a record high. Australia's ASX 200 rose 0.4%, also scaling new peaks. In India, the BSE Sensex rose 0.1% to a new all-time high. Meanwhile, Japanese shares retreated from all-time highs on profit-taking. The Nikkei 225 hit a record high yesterday before closing 1.2% lower and back below the 40,000 mark. On today's programme, I'm joined by Lawson, Asia Chief Economist at BBVA, and Nitin, Dialdas, Chief Investment Officer at Mandarin Capital. And with a view from Australia is Toby Lawson, the CEO at Statton Partners. Please take a look at my daily Asian newsletter, which accompanies this show. You'll find it at peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
On Wall Street, US stocks staged a broad rally, pushing the S&P 500 back to record highs as Fed Chair Jerome Powell said the central bank is not far from gaining the confidence to lower interest rates. The S&P 500 was up 1% at 5,157, led by tech stocks and communication services. The S&P's gains today made it positive for the week and puts it on pace to be the 17th positive week in the last 19 weeks. The tech-heavy Nasdaq Composite was 1.5% higher at 16,273, with 6 of the Magnificent 7 stocks advancing. Nvidia led the group with a 4.5% increase, while Meta added 3.3%, hitting an intraday record earlier in the session. The Dow gained 130 points, that's 0.33%, to 38,791. The yield on the US 10-year Treasury on the 10-year Treasury fell as much as 5 basis points at one stage to 4.06%, the lowest in a month as investors become increasingly convinced that interest rate cuts are imminent. It ended the session 2 basis points lower at 4.09%. And the dollar was down for the 5th straight day to the lowest close since January the 15th. The US dollar index fell 0.6% to 102.82. The dollar's losses were driven in large parts by the Japanese yen's strength. The yen appreciated 0.9% to 148 per dollar, climbing to its strongest levels in a month amid growing speculation that the Bank of Japan could raise interest rates this month. Spot gold hit another record high as the dollar weakened, climbing 0.7% to $2,160 an ounce. Oil prices were flat Thursday. May Brent futures settled at $82.96 a barrel. Bitcoin was 2% higher, trading at $67,870, and Bitcoin reached an all-time high on Tuesday, topping $69,200. In Hong Kong, the Hang Seng slipped 208 points or 1.3% to end at 16,230, mostly giving up gains from the prior session. Geopolitical tensions mounted after the US called on its allies to further tighten curbs on China's access to chip technology. Also weighing on stocks was a proposed US bill that targets biotech firms. Wuxi Biologics retreated 21.5%. Wuxi AppTech, which generates two-thirds of its revenue from its US business, dropped 20.6%. Pharmaon was down 16%. Looks like the Hang Seng is going to rebound about 90 points at the open this morning. Futures markets pointing to a start of about 16,320 for the index. And you can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
We've reached the end of the week. Let's welcome our Friday morning guests. We have with us Lashar, who is Asia Chief Economist from BBVA. Morning, Shark.
Morning, Peter.
And also with us Nitin Dialdas, who's Chief Investment Officer at Mandarin Capital. Welcome back, Nitin.
Morning.
China's foreign trade grew faster than expected in the first 2 months of this year. That was partly driven by electronics and also increased exports to emerging markets, especially Russia. Data showed that Chinese exports jumped 7.1% year on year in January to February. That far exceeds forecasts for a 1.9% gain amid resilient foreign demand. And it followed a 2.3% gain in December. China reports economic data for January and February together to account for the disruption of the annual Lunar New Year holiday. Among trading partners, exports grew to the US by 5% and to Russia by 12.5%. And for the year of 2023, outbound shipments shrank by 4.6%. Shark, seems like potentially good news for the global economy and China's economy. What do you think about the data?
Definitely, I think the data is much better than people expected. As you explained, I think the export to emerging market, including Latin American, Russian, and Africa, they have a very good performance in the first 2 months of this one. And I think they benefit from the electronic cycle. That's a global story. I think overall, that's a very good news to not only Chinese economy, but to global economy. That means we have a good start because China is one of the most important trade partners in the world. So that's good. But we know that at the beginning of the year, all this effect could be distorted by this Chinese New Year holidays, right? So sometimes people, they put this January and February data together, but even so, I think sometimes because of these holidays, they fall on different calendar days, that could have some negative impact on or positive impact on the data outturns. So I think we have a good reason to be optimistic on some point. For example, this electronics cycle, it is coming. That's good because last year we suffered quite a lot. If you look at this Asian export to the rest of the world, last year overall they down by around 5 to 10%. That's quite big down. But this year we have a good beginning. That's very good. Also, it seems that in some emerging market, I think partially that's related to this Chinese relocation or nearshoring strategies, because United States and EU, they are become increasingly cautious about this trade relation with China, and China must find a new market. Then they start to invest a lot. They start to trade a lot with the emerging market. That's good. But overall, as I said, that's only 2 months. Data, we need to be careful. And China, they have a lot of the domestic problem, and we don't know how these kind of the things will involve, because in addition to US, it seems that the EU, they don't feel comfortable with the Chinese increasing export to their countries. Yeah. So
Nitin, what do you think about the data? A good start, isn't it, for the beginning of the year? But is this going to continue going forward? And is an improving external trade environment, is that going to be enough to get China to its 5% growth target for this year?
It definitely could start, and definitely helping it get towards that target of 5%. Let's see if it continues though. I think a lot of that is down to, I mean, if you look at the numbers, a lot going to Latin America, that's probably down to the nearshoring and obviously sending a lot of goods to Mexico in order to then onward import into the US. So I think relatively cautious. I mean, there are a few worrying numbers. I mean, trade to Japan, trade to Korea, which is its nearest neighbors, was down quite a bit. So that's not necessarily too positive. You've got, I mean, what was interesting was seeing the 5% rebound in the US, even though the US is trying to do a lot of stuff against China. UK was relatively stable. EU is a bit of a basket case. So, I mean, even though that was like negative, you're not really too worried about EU because that, as I said, EU as a region is not doing too well. So I think you're looking at that and thinking generally good start. Where it goes, we'll see. I mean, I'm not yet turning around and going, "Oh, this is super," and China's coming back, and China's going to be the net, back to what it was. But at least now we're starting to see some signs of stabilization and some signs of bottoming coming through.
And a couple of things that stood out. First of all, Russia. I mean, Russia's ranking is rising rapidly with China. Bilateral trade grew 9.3%. Exports were up 12.5%. And Beijing touting its strategic relationship with Russia, saying this is going to be an important element going forward. What do you make of that?
Yeah, I think that's interesting. But again, it's by design. I mean, US has got all these sanctions and asked all the allies to put all these sanctions on Russia. Russia's got to get its goods from somewhere. Why not from its neighbors? And China's, while they're claiming to be relatively neutral, they have supported Russia in a big way. So this is just further signs of a strengthening relationship. And I think the West has to be a little bit careful in what they're doing because you're going to drive a lot of these alliances, whether it's Russia, China. I wouldn't be surprised in a couple of years. I mean, I know it's 2-3 years down the road. If India continues on that growth, that US starts putting all these measures against India and all this kind of stuff, because US just doesn't want to be threatened in terms of being the world's largest economy. It's anyone that keeps growing too quickly. But then what they don't realize is they're forming all these alliances across the world that will actually ultimately hurt. And China will get pick up from Russia and other places. So I think there's got to be a little bit of caution in the way that some of the moves that's happening in the US has got to play out.
Because it's led now to Russia becoming China's 5th biggest single country trading partner last year. So I'm sure this is not going to please the EU, is it? Because they're seeing the additional trade with Russia as helping their campaign in Ukraine.
Yeah, for sure. It's not going to please anyone in the West, not the US, not the EU, not even, But at the end of the day, they've driven it, haven't they? So, I mean, I think they've got to look at themselves in the mirror at some point and say, well, you can't bully the world. You can't tell everyone that they can't trade with Russia. There are going to be people who will. And unfortunately for them, the world's biggest manufacturers are happy to trade with Russia and offer them, I guess, decent rates on those goods too. So, as I said, all been driven by what's been going on with the West.
Shark, how big an impact is electric vehicles having on these trade numbers? We hear a lot about that, don't we? About how China is becoming the largest market for both electric vehicles domestically and also its exports of electric vehicles as well. Is this a factor?
Yeah, I think definitely this EV things, they helped China quite a lot. Last year, people said China export more than 1 million EV cars. But the interesting is it's not only just the story about EV cars. When I talk to my client, I always direct them to the fact that in addition to these EV cars, the Chinese competitiveness on the traditional auto sector has been increased quite a lot. They export a lot of the traditional cars to Russian. Okay, now the Russian is the biggest export market of the Chinese cars, and also they export a lot of the cars, traditional one and the EV ones, to other emerging markets, Mexico, Thailand, Brazil. So it seems that China, they do build some kind of the competitiveness in these auto sectors, not only just for EV, but also for these traditional auto sectors. And this one, if this year I think this year China they have a much more ambitious plan to export around 10 million cars, including EVs, including these traditional cars, to the rest of the world. They almost double the size of the last year. So I don't know how their trade partners will react to this one. For example, Japan, Germany, I think that their industries quite rely on their auto industry. Now they lag behind in these EV sectors. But if they feel that their traditional turf, this traditional cars market share has been eroded by China, I don't think they will feel very comfortable. That's why I worry that although, of course, this competitiveness of the Chinese export, they are good things, but the reaction from these important trade partners not that good. Maybe they will react with more protectionism.
And Nitin, well, we've got all sorts of signs of more protectionism coming, haven't we? We've got reports of Washington trying to push its allies, the Netherlands and Japan, to tighten chip-making restrictions on China. We've also got reports of China trying to completely remove US software in their IT systems by 2027. I mean, it could be that this might be just a blip, and trade's going to get tougher going forward.
Yeah, but what I find interesting is, if you notice the rhetoric, it's like because China's made such advances in the chip world. But what's driven those advances is the fact they've been forced now to do that because of all these sanctions. So you put more sanctions, all you're doing now is driving innovation and further innovation into the chip sector in China. So again, I think a lot of this hasn't really necessarily been thought out properly. It's like, yeah, this sounds great. And to be fair, I think a lot of the US is really about, how do I win an election? So if I turn around and go, I'm going to put more sanctions on China, hey, those are both winning points. But what you're actually doing is driving further innovation in China and actually helping China get ahead in the chip game. Now, you can say, let's ask Japan, Korea, all these places to put sanctions on Chinese chips. But again, you can't tell the whole world not to. So you've got these advancing China chips. If they're only going to support places like Russia, and other places which are anti-US, you're strengthening the bloc that you don't want to strengthen. So I think it's going to be an interesting how this all plays out. But what it does do, for sure, is drives that innovation and that ability for China to start getting better and better chips out there. And we've seen that with what's going on.
And it's driving the global trading system into competing blocks now, isn't it? There's sort of China and Russia and its allies, and then the US and the EU and its allies on the other side.
Oh, 100%. I'm not sure which side you want to actually pin your flag to. Obviously, it'd be nice to be Switzerland and just be completely neutral. But it's going to be interesting, as I said. And the innovation war, I would not count China out of this. And I think that was the whole thing. Maybe it was like, if we slow down China, the chip making China, they've not got the ability to come up with these, super chips that will be strong on AI and everything like that. But I wouldn't bank on that. I think China will come up with some great chips in the next year or two. And that will be a big challenge to companies like NVIDIA, TSMC and all these. But what is also interesting is NVIDIA do want to trade with China. They might be, there as a behemoth of AI and, the current, leading chip maker in terms of what's going on in the AI sector. But one of the things they've always wanted to do is trade with China. So, I said all of these things will be interesting to see how it plays out.
Shark, how important is trade going to be in helping China achieve this 5% growth target that it announced at the MPC earlier this week?
Of course, I think if they want to achieve this 5% growth, they must have a good performance on their export sectors. But I think, as I said, nowadays, people, they expect this export sector maybe contribute to very minor part to this 5%. But if they have this negative growth, then they will have trouble. So in our scenarios, if this export sector overall, they contribute to 0.3 to 0.4% of this total growth of the 5%, that would be very, very good one. It will help the Chinese economy to stabilize at this 5% target. But still, I think the overall, this 5% target is still very tough, because if you look at the share of the Chinese export to total GDP, it's much smaller, 20%, right? So that means China, they must rely on their domestic market performance. They need more consumptions, especially for private consumptions, to boost the economy. They need a very decent investment. But I don't know in which areas, because they have invested a lot in infrastructure, but they invest a lot in the past, they invest a lot in this housing market. But now it seems the housing market have trouble now. And then if you want to invest in infrastructure, you need to depend on this local government to invest more money. But unfortunately, now the finance situation of this local government are not that good. So yeah, it depends on this manufacturing investment. But that one is wild card. You don't know how it will perform, because you need to stimulate people's animal spirit. Okay, so I think that what lack now in China is it seems many people in the past they have very good animal spirit, but now it seems they don't want to fight. They don't want to make more money. Okay, that's a problem. Yeah.
Nitin, are you confident China's going to meet the 5% growth target, or is this going to be rather tough?
I think they'll definitely publish the 5% number. Whether it's met in reality, who knows? We all know how numbers are in China. I think for China, the biggest problem is the domestic situation. They've got to get consumer confidence coming back. They've got to get people back confident in terms of their jobs. You've got to start getting the youth in employment. They've set pretty hefty targets in terms of getting a lot of that youth back into the workforce. Started into the workforce in a lot of cases. So I think those are the problems they really have. It's all very much in terms of domestic consumption. And how do you start getting your people confident again when they've had 3 or 4 years of very, very tough times? I think that's their biggest challenge. If they can work out a way that they can get consumer confidence back, jobs back in there, and let's not forget the demographics are poor. You've got declining population. You don't have a lot of people who want to go and emigrate into China. You've got a lot of people who have kind of moved into China, having moved out and wanting to move out. So there's, in all of those situations, it doesn't bode well, especially if you're trying to use something like property as your prop to get the consumers a little bit more confident. You're not going to see property prices rising if you've got declining populations and people leaving the cities and country. So I think that's something they have to really focus on and figure out how they're going to play this. Unfortunately for them at the moment, there is this propaganda war with the West, and therefore you're not going to see foreign companies go back into China in a big way anytime soon. Yes, they've wanted to be self-sustaining, but that's not possible. Not with the way the demographics are. So that's what they've got to kind of change, and let's see if they do.
Okay, let's talk about the central banks. First of all, the European Central Bank kept interest rates on hold yesterday as expected, but it did lower its annual growth forecast for the fourth quarter in a row, and also its inflation forecast as well. Its benchmark deposit rate is currently at a record high of 4%. It's climbed from minus 0.5% in June 2022 after a run of 10 hikes. The ECB now sees economic growth of 0.6% in 2024 from a prior forecast of 0.8%, but its inflation forecast also brought down to 2.3% from 2.7%, and inflation expectations were also revised down to 2% in 2025. So basically, Shark, the ECB is saying inflation's going to hit its target next year. What's to stop it cutting interest rates now?
Yeah, I think that they need to cut the interest rate because if you look at the inflation, you look at the GDP growth in Europe, I think now they are sliding into a recession, right? Maybe not that big in recession, but definitely no one expected they have very good performance this year. We forecast that they are going to cut the interest rate from June, and they will cut 3 times this year in June, in September, and in December. So 3 interest cut for the rest of the year. But still, even with this interest rate cut, we don't expect that they will have a very big rebound or recovery in their economy because they suffer quite a lot. They have a lot of the structural things. So we cannot expect they are going to fix that one in the short term, especially for this Ukraine and the Russian wars. I think that this one will continue. Europe, they will continue to suffer.
Nitin, it seems, doesn't it, that the ECB and the Fed are preparing the ground now to go and cut rates. We had Jerome Powell saying yesterday in front of the Senate that the Fed's not far from having the confidence it needs to start cutting interest rates. He wants more. He wanted to leave borrowing costs steady until it had more evidence that headline inflation could hit the central bank's 2% target. But he's going a step further now by saying, how soon the Fed might get there. He's saying when we do get that confidence, and we're not far from it, it's going to be appropriate to dial back the level of restrictions so that we don't drive the economy into recession. It looks like rate cuts coming from the ECB and the Fed.
Yeah, it looks like it. I'm a bit surprised about the Fed speak, to be fair. I think the ECB, that as Shark said, it needs to happen. As I alluded to earlier, the EU is a bit of a basket case economically, so they need to figure out how to stimulate growth there. But in terms of the US, I am a little bit surprised because the numbers are still pretty healthy. Inflation's starting to come down, but if you look at the employment numbers, they're still pretty good. So to me, that one is a little bit of a surprise that he's already starting to talk down the book. But I guess, they're looking at, they've got, forward-looking numbers to a certain extent, and maybe seeing stuff there that will drive a cut. What I think they've got to be very, very careful of is they don't want to cut too aggressively either. And I know the markets are pricing in 4 rate cuts of 25 basis points each to cut it by about 1 percentage point. But I'd be careful. I think they would probably need to do maybe a couple of cuts early, see how the economy absorbs that, because you don't want to start getting your economy overheating again too soon. And the economy is in a good period. So just cutting rates might stimulate growth too much or stimulate too much activity, which starts bringing back that inflation. So I would think they would be relatively cautious in how they proceed with the rate cuts, although given what Powell said yesterday, maybe they do a couple of cuts, in June and soon after. But beyond that, I would probably then think they would probably pause and have a look.
Shark, what about Japan? We had some important data yesterday out of Japan. Cash earnings in Japan rose by a bigger than expected 2% in January. That's the highest reading in several months. So the country's nominal wage growth has also matched the 2% core consumer inflation rate in January. So that's resulting in the slowest pace of decline in inflation-adjusted real wages in 13 months now. And also Japan's biggest industrial union group, Zensen, said that company management have agreed to raise full-time workers' pay by 6.7%. This is what the Bank of Japan wants to see, doesn't it? It wants to see, workers' pay being raised by the employers. Does it put this month's Bank of Japan meeting into play now for an interest rate rise?
Yes, I think many people they're speculating that maybe Japan they will hike interest rate this month or maybe early this year, but I'm not sure because for Japan the economy has got used to this kind of a negative interest rate, this high debt level and the slow growth. It has been lasting for too long. So now we have seen some positive signals. Maybe they could end this one. But I think from the perspective of policymakers, they must be very careful. Because in the past, it shows that Japan's economy sometimes they appear very vulnerable to these external shocks. Remember back several years ago, when they see the good signal, they hike their consumption tax rate, and then they have the trouble. They have this recession again. I think these things could repeat if they hike their interest rate too soon. So I'm very cautious on this one because I think even they decide to hike interest rate, they must be very careful to follow this step-by-step approach. I think it's a very dangerous to change the regime because the entire society, the old people, they get used to the old mode. Yeah.
Okay. Nitin, what does this mean for the markets? We saw the Japanese yen jump on this speculation that the Bank of Japan is about to raise rates. It's at 148 per dollar now. It was up about 1% overnight, and the Nikkei 225 slid. What's the upside for the currency here if we do start seeing this come to pass?
I think I'm not sure in terms of the upside. I think basically what we're looking at is actually what's going on against the US dollar. Because we talk about the yen jumping back to 148, but the pound's back above 128 against the US dollar. The euro's back above 109. So you look at all of those it's just generally dollar weakness, and I think that's come across against Powell stating that they'll start cutting, or they're happy to start looking at cutting rates soon. So in terms of Japan itself, a little bit of a rate rise will be good because you need to get some of that inflation. No, I mean, I think you've got to start matching up against inflation. And the reality is people are losing in terms of real interest rates. And Japan is a net saving economy. So I actually think in terms of the economy, it won't be a negative thing to have rates rise because people will be starting to get some return on their actual savings, which they haven't been able to do for the last 30 years. Mm-hmm. So that might actually be a positive surprise, which then should start lifting the yen. Where does the yen go? I don't really see it going too much past 140. But, it's tough because I think if people start feeling a little bit better, and I mean, Japan's been pretty positive, so I shouldn't say they're not feeling negative about anything, but they are in a recession. They've had 2 negative quarters of growth, despite the fact that everyone, the market's at record highs and all of this. So it's kind of an interesting play that Japan at the moment. From what I've heard, people are starting to get a little bit cautious. Last year was quite positive, but people are starting to get a little cautious. But I think if you do give that little bit of an interest rate boost, people get a little bit of returns on their savings and spend that little bit more, you could see the economy come back.
What does it mean for Japanese stocks?
Look, they're at record highs. I think the stock market, a lot of it is played against the yen. So the fact they're record highs, I think a lot of, I mean, not all, but quite a bit of that move is down to the fact the yen has fallen down to, had fallen below 150. I would think the stocks stabilize at around these levels. If the yen strengthens, you probably see a bit of a pullback. It has risen quite considerably, up to, above 40,000. So if you see a pullback, say, to about 33, 34,000, that won't be unnatural. Mm-hmm. And then you can start reassessing the market at that point, I would say.
Shark, what's interesting is just how many asset classes are at all-time highs at the moment. There seems to be a real liquidity surge, doesn't there, going into the market? We've got gold at all-time highs, Bitcoin at all-time highs, then stock markets in the US, in Europe, in India, in Australia, in Taiwan, all at all-time highs. As we just said, Japan just below its all-time high. There just seems to be this global liquidity run driving everything higher at the moment.
Yes, I think that now people expect the U.S. They are going to cut interest rate. Then we will have more liquidities in the market, and people they do bet on that one. And for this Bitcoin, for this gold, I think that people think that's a good hedge during this period because you are going to have a lower interest rate then. The value will come up. But you can still find value things in the world like H share, A share, they're still very cheap, right? We cannot see all the asset class come to a new high. So you can still find a relatively value here in Hong Kong, unfortunately. I think that this geopolitics problem do play a very important role to the valuation here in Hong Kong. But outside Hong Kong, it seems that now people, they have a very good sentiment about this asset class across the board.
Nitin, what do you do when everything is at record highs? Do you chase it or do you look at maybe some of those things that are a long way from their record highs, like China and Hong Kong stocks?
I think you can't necessarily fight momentum, but if you've been in it for a long time, you probably want to start taking some of those profits off the table. Position yourself to start looking at markets like China and Hong Kong, which, as I said, you can't fight momentum, but you could probably start looking at them to see if they start gaining some momentum and try and get in early. If you're not in it, why not take your 5-6% or 4.5% that you can get in interest for now? I wouldn't start. I don't necessarily think it's worth chasing. You could probably dabble a little bit, but you've got to be pretty nimble and pretty quick because momentum can turn very quickly. It only takes a couple of data points to change that. But at the moment, I think, you play the momentum. I don't necessarily flood Hong Kong or China, but probably start positioning, take some profits off your table to position yourself to start seeing if those markets come back. Worst case scenario, like I said, you're getting 5-6% anyway in interest. But, I wouldn't, I'd probably still try and play a little bit, but be very cautious with where it goes. Those markets to me are very, very overvalued, but momentum takes you a long way. So I wouldn't say it's definitely time to get out here.
Okay, well, thank you for the advice. Good to talk to you both and have a good weekend. You heard there Nitin Dialdas, who's Chief Investment Officer at Mandarin Capital, Lashar, who's Asia Chief Economist from BBVA.
Peter Lewis's Money Talk.
I'm joined now by Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia. Morning, Toby.
Yeah, good morning, Peter.
Jerome Powell yesterday said the Fed's not far from having confidence to cut rates. He said to senators that the FOMC was in the right place on monetary policy and leaving borrowing costs steady until it had more evidence that headline inflation at 2.4% in January could hit the central bank's 2% target. But he did go one step further during his second day of testimony overnight by qualifying how soon the Fed might get there. He said, when we do get that confidence, and we're not far from it, it'll be appropriate to dial back the level of restrictions so that we don't drive the economy into recession. It looks like he's talking up rate cuts, doesn't it?
Well, it's a bit like a father driving a family to a holiday and the kids shouting, "Are we there yet? Are we there yet?" And him saying, "Yeah, we're close," but could be a few more hours yet. So I suspect he's trying to manage expectations enough to give him some wriggle room. And I think where the Fed is most worried is going too early more rather than too late at this point in time. And hence, I think they're err on the side of trying to hold out as long as they can to ensure that they don't leave the potential for inflation to be entrenched at a higher level. So I suspect right now he's giving the market a sense that we're close. We've peaked at least. He affirmed that, and that's been pretty clear in terms of market pricing. But holding out the opportunity to extend that time period for the first rate cut as long as he can, because the way that the market dynamics look in terms of economic growth, there's no immediate sense of urgency to provide accommodation, given the data we've seen, given the way the labour market remains tight. So I think he's buy as much time as he can.
The markets, though, seem to be getting more and more into the mode that rate cuts are going to come probably around about June time.
Yeah, I think that's the pricing currently. And I think that's reasonably consistent with how that, and it also was sort of pretty much affirmed a bit in the ECB as well overnight with Lagarde sort of revising growth forecasts and inflation. And I think out of that type of conversation, June was pitched as a potential rate cut for Europe as well. So I guess they're trying to. I don't think they line up for in terms of direct communication, but there'll certainly be some idea of lining up rate cuts according to all central bank movements.
Now, the ECB was interesting, wasn't it? Because as you mentioned there, they brought down their inflation forecast, left interest rates on hold, revised down their growth forecast, but brought down inflation to forecast to 2.3% for this year from its previous forecast of 2.7%. But now next year, it's revised down its inflation forecast to 2%. So it's basically saying it's hit its target next year. So is there anything to stop the ECB cutting rates, maybe even earlier than the Fed?
Maybe. I got the sense that they're probably going to, short of worse economic growth figures, which are already being revised down to 0.6 on growth. If they get indication that that's any worse, they'll go more quickly, assuming that the inflation forecast remains to 2% by next year. So I think it's possible because the European economy is not chugging along as strongly as the US. So it's possible that the ECB may move before the Fed, but it'll probably be driven by data in the next 3 months on economic growth, which will be a key factor.
And what is interesting is the markets at the moment. We have so many asset classes, so many things at record highs. Bitcoin hits a record high this week, gold at a record high, stock markets around the world, in the US, in Europe, in Asia, Japan, India, Taiwan, all at record highs, and Australia as well, I think, wasn't it? That hit a record high as well this week. There doesn't seem to be any fear in the markets at all at the moment. There just doesn't seem to be any bad news that seems to dissuade anyone.
Well, we saw earlier in the week that the markets turned over in the US for that a bad day, but they recovered fairly quickly. It's an interesting story around US stocks and using them as a proxy for record highs across asset classes, exception of bonds, of course. But the way the market's responding to growth versus inflation. And one of the interesting discussions that I was reading about was the idea that actually what's happened is inflation's come down because of an improvement in the post-COVID supply chain. So that's a real cost reduction, a real inflation reduction, which actually has improved productivity, which means profits are stronger, and that's been reflected in corporate earnings. And so the idea in the short term that the inflation decline is actually, despite the higher interest rates, the growth dividend or the profit dividend from the improvement in productivity has been greater. And hence equity prices have stayed up despite movements in bond yields and despite movement in interest rates. And that's probably run through the market now, and it's reached this point, well, that's all been priced in. And so what are the longer term productivity potentials for the equity markets to sustain their record highs? And that's the one which people are talking about, AI and the impact of structural productivity improvements driven by technology and digital. And that's the one that I guess will start to have to play out over the months ahead. But interestingly, people arguing that why have markets not reacted to higher interest rates in a negative sense in the equities is because the dividend coming out of lower inflation and the profitability of companies outweighs the higher interest rate costs, particularly at the large corporate, large cap sector in the equity market. So that's an interesting explanation.
There is also a sort of a school of thought that says that what we're getting here is a massive liquidity injection, because in effect the US government's doing a sort of fiscal quantitative easing, because government spending is about $6 to $7 trillion. And it's the Fed that's basically buying these bonds off the government, and that's sort of outweighing its tightening of its balance sheet, the running off of its balance sheet. This massive liquidity is sort of lifting many stock market boats at the same time. Do you think that's a reasonable explanation?
Yes, and I think you look at the risk appetite in corporate bonds. So the credit risk appetite for investors is also quite high in the corporate sector. So if you've got government spending as one factor, which is driving growth, you've also got appetite to buy debt in the corporate bond sector, which means the risk appetite for investors is improving. So they're putting more risk on, and that's something that suggests that people are more confident about the outlook for companies more broadly in terms of growth, and that's so that is outweighing some of the concerns that are priced in normally towards the cost of higher interest rates and slower demand. So yeah, it's an interesting thesis, and definitely government spending is one aspect.
What should we be looking out for if we're worried that maybe the stock market is entering a topping phase? Because we've seen in the past, historically, unlike where you get to a market bottom, where it's sort of quite a big event, isn't it? You tend to get to a bottom and then a big V-shaped rebound. These tops can take many months to form. But should we be looking out for warning signs that maybe what we are seeing now are the stock markets topping out?
I saw an interesting data on the challenger layoffs in employment. The figures that came out said that the layoffs for February were the highest in 15 years, and 9% higher than a year ago. I think so. For the purposes of risk, I guess the labour market's softening and the economy slowing quicker than what people have forecasted for the equity market or for the economy. That's a red flag. And we're starting, maybe that's the figure that we should be looking at, leading indicator on employment, because if that softens, that would be definitely a factor that would drive sentiment, because what's driving stock prices is not necessarily just the expectation of lower interest rates. It's the fact that companies are going to continue to grow through productivity. One, driven by lower inflation, secondly, by technology and by structural productivity. And if they get that wrong and employment comes off, then that could shake confidence.
We should expect that these layoffs, because as you say, they've been quite high, to start feeding through to the jobless claims numbers at some point. They haven't so far, have they? But you would expect that at some point we start to see that. So you can't sort of have this record number of layoffs without the jobless claims being affected, you would have thought.
Yeah, so statistically, I don't know how that lines up, and often it's the seasonal adjustments that they put into some of this statistic work. We'll see the payroll number tonight, so that might give us a leader. But what we're often seeing is reasonably big swings in payrolls, but no movement in the unemployment rate. So either it's a statistical quirk in the participation rates or whatever. But you're right, it's not necessarily correlating, because we are seeing anecdotally some quite big layoffs, particularly in the tech sector. But if you look at the tech sector in terms of equity performance, it's at record. So, that dislocation we haven't quite rationalised as investors. But we'll be watching certainly the labour force figures coming up to see if there's any feed through. More broadly, I think economic activity seems to be pretty good in the US, but market is priced for continued growth. And so any adjustment of that's probably going to have the negative impact on sentiment.
Well, one market that took my attention this week that's also hit a new all-time high, one of our favourites, is India. There seems to be a lot of positives behind that market rally. But what do you think about India?
Yeah, it was actually an interesting discussion there. But you talk to fund managers now when they talk about Asia and emerging market opportunities. India is definitely top of conversation. Its performance has been excellent. But an interesting stat I saw that everyone talks about lofty valuations, but essentially the growth in the stock market is sort of aligned with the growth in earnings per share across most of the large corporates. So it's actually it's not necessarily bubbly, and it still has probably more upside, because you've got the Indian economy that was quoted to grow at 7%, is probably going to grow at 8.5% and beyond, and it's structurally going to grow for quite a period. So it's a very positive outlook for India, and we notice when we're talking to fund managers now that when they're talking Asia, they're pivoting a lot more towards having exposure into India, and that's likely to continue. And that also is structurally on the basis of a pivot away from China. So if you look at a lot of the emerging market funds, or at least a lot of the Asia-centric funds, China represents 30% allocation, and that's possibly being adjusted lower relative to a push maybe towards India. So the outlook for India is very strong, and the main red flag in India, which I say to most people, is really politics. And whilst Modi maintains a good, strong position at the centre and the BJP likely to be re-elected, that's been very, very good for India. Regardless of whether you agree with the policies, that stability at the centre has really been helpful. And that's likely to continue in the next political cycle, which will help continue to drive positive news for India.
Toby, thank you very much indeed, and have a great weekend. That's Toby Lawson, who is the CEO of Statton Partners down in Sydney, Australia.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on other headlines and market moves in my daily newsletter. Take a look at peterlewismoneytalk.substack.com. I'll have more business and finance updates for you on Monday. Joining me then are Alex Wong, Director at Alex KY Wong Asset Management, and Sunil Kashyap, Director of FinMet. Providing a view from mainland China will be Brock Silvers, CIO at Cayenne Capital. Have a great weekend.
Money Talk